A mutual fund is a collection of stocks, bonds, cash, and other securities that are managed by a professional. Generally, people buy mutual funds because they want a simple way to invest in a diversified portfolio, with the security of knowing that someone will be watching it. Here's an example of how a mutual fund works. Here's Will. Will has been investing for a long time, with consistently awesome returns. People are always asking him for investment tips and financial advice. So Will decides to start a fund, where he will manage and invest for people. He registers with the authorities, gets the approval, and sets up a mutual fund. He calls it Will's Fund. Because Will is such an awesome investor, he is able to convince 10 people to invest $1,000 in Will's fund. Each investor owns one share of Will's mutual fund. Each share is worth $1,000. This is referred to as net average value. With the cash, Will invests in some stocks and bonds and leaves a little left over in cash. This portfolio is referred to as his assets under management. Will also takes a small percentage of the fund as his fee. This is called the asset under management fee. Let's fast forward 3 months. Will has made some really wise stock decisions. He was able to grow the portfolio from $10,000 to $11,000. Because he made an additional $1,000 and he has 10 shareholders, each of Will's friends will make $100, bringing the net average value of the mutual fund to $1,100. Will's fund is an example of a close-ended fund. He raised the money for his fund through his friends and is not accepting any more funds from outsiders. If one of his friends wants to sell their position, they would have to trade it to another investor. Mutual funds are traded on the stock exchange.